I'd like to thank everybody for joining me today. Today, I want to talk about charitable planning. We put off charitable planning a lot of times till the end of the year, and it's the rush, rush, rush trying to get it fit in before December 31st. But I like to look at charitable planning as an option that we can use throughout the year and make sure that it becomes part of our planning tools that we're presenting to our clients. A lot of times when we start looking at charitable planning, the question always comes up, well, what assets can I use? Well, pretty much any asset can be used for charitable giving, as long as that is not typically an ordinary income item or has debt on it. So if you think about it, we want to be giving tangible items to the charity and things that they can use. A lot of times I like looking at this and saying, let's make sure we're giving away things that have high fair market value compared to a low basis so that we let the charity take care of that capital gains problem and not you individually. And a lot of times I see that mistake, especially in direct gifts, because what happens in a direct gift, if you think about this, with direct giving, I love direct giving because this is typically where you're going to give money to that charity because you want to see the good that that charity can do with your money. Sometimes it's, businesses do it for marketing purposes, but a lot of times it's done in a way that we just want to see the good that can happen with the money that we're giving. Well, if we're doing that, we get a tax deduction based off the fair market value. Now think about this, and if you're looking at a highly appreciated stock in your portfolio, let's say you're going to give away 10,000, want to give 10,000 to that charity. Well, give the stock that has a low basis, 10,000 fair market value stock. Maybe it has $1,000 basis. That's 9,000 of taxable gain you don't have to pay, but you get to write off a $10,000 charitable deduction on your tax return. So direct gifts are a great, simple way to give money to charities. One of the things that I think is becoming more popular, and that's qualified charitable distributions. With qualified charitable distributions, think about the problem. And I deal with a lot of clients, they just don't need to take, money. They don't want to do their RMDs. They've got enough money to live on. They don't need that extra money coming in. Well, with a qualified charitable distribution, the client can give money to their charity, can give their IRA money to the charity. Now, they don't get a tax deduction for it, but they can exclude that income from their taxes. So, number one, they have to have an IRA. They have to be at least 70 and a half. And the maximum they can give right now is 105,000 per year. And this can count towards their required minimum distributions. So it's a great way. Don't recognize the income, give that IRA to the charity and let them use it, and you can see the good that they do and exclude it from your income. Now, anytime I get into planning, I'm always looking, can we leverage our gifting? And even in the charitable world, I'm looking, can we leverage our assets? So if you think about this, a lot of our clients have assets that are underperforming, not being used, they're just there. So think about CDs, savings accounts, investment accounts that are not doing anything particular for that client or just not being utilized to the best of their ability. If we can reposition these assets and reposition them into a life insurance policy, what I like here is if we need to do it over time, we can take that money and put it through a premium deposit account or a single premium immediate annuity. That lets us spread that if it's going to generate any tax problems, at least we can spread that tax problem over multiple years because now we have a problem of we want that going in over time. We just don't want a big hit on the taxes up front. So the SPIA can work good there. We get that money into the life insurance policy. What I like here is let's take that life insurance policy. In most cases, we're going to make it a cash value policy. This creates that what if account for our client. You know, what if they need the money for their business or long-term care to go on trips, give money to their children or grandchildren. They just don't know when, if, and how they're going to do that. we've got this account, this cash value account growing inside the life insurance policy. It's growing tax-free. We can access it tax-free whenever we want or never access it. If we don't access it, the death benefit just keeps growing, or we don't drain it because we've been taking that cash out. But it creates that nice tax-free what if bucket of money to allow our clients to utilize that money if, when, and how they want. Now, when they pass away, we can look at leveraging that gift and leveraging that death benefit, and we can have our clients can now give more to the charity at death, and it's one they can split the death benefit. Maybe some of it goes to their heirs, some of it goes to charity. But if I look at, let's just assume that we had a CD of, $500,000, and that CD can buy, just for ease, let's say $1 million of death benefit. Well, if they don't touch it after they pass away, they can still give a 500,000 tax-free to their heirs and give the other 500,000 to the charity. It's a win-win scenario, but along the way, remember that what if account gives our client the ability to take care of those unforeseen things that just pop up through life. So there again, nice planning tool, leveraging assets that are just not being utilized, underperforming, but reposition them into something that will be better for them, better for charity. And of course, when we start looking at this and we start looking at charitable giving, I look at charitable giving plus. And with charitable giving plus, we're looking at clients that want to give money away, but they still need retirement income or benefits back to themselves. So a charitable remainder trust can be a great tool. With a charitable remainder trust, we set up the trust, we decide, how much of this payment is going to be paid back to our client, and at the end of the trust term, whatever's left goes to charity. So think about this, we're going to transfer that asset into the trust. The nice thing about transferring an appreciated asset into the trust can sell this income tax free and reposition that asset, that rental property, that business stock, whatever it is, they can reinvest it tax free into a liquid portfolio. With that liquid portfolio now we can pay a percentage back over our client's life or joint lifetime, and that's going to be a set annuity percentage. So 5%, 6%, 7%, whatever it is, that's going to pay back to our clients, throughout their life or joint lifetime. They create a charitable deduction on the front end on the transfer to the trust, but they get that lifetime income to make sure they have their charitable retirement money. When our clients pass away, or if it's a joint trust, they both pass away, whatever's left goes off to charity. So what they know is they get the charitable deduction when they set up the trust and move the property in. The trust can reposition that into a liquid portfolio to now change assets into income. They get lifetime income or a set period of time, whatever it makes sense for them. And then whatever's left at the end of their lifetime goes to charity. Charity can get a lot, they can get a little, whatever it is, they get something. If we look at a charitable lead trust almost is the opposite of a charitable remainder trust. When we transfer that property in, we're going to get a charitable deduction. Now, with that charitable property inside the trust can now reinvest those assets inside the trust. Now, one thing to be careful of, we don't get a tax-free treatment inside the trust. So any taxable gains inside the trust are going to be taxed back to our client. But during their life, or should say for a set period of time, 5 years, 10 years, whatever, a payment is going to be made out to the charity. So now what I like is we get a charitable deduction now for our client. They get to see the charity receiving money and the good that they can do with their money. And at the end of the trust period, that 5, 10 years, whatever it is, whatever's left in the trust comes back to our clients, and now they can use that for their retirement income, pass on to their heirs, there again, whatever they want. So the mechanics are a little bit different, accomplishing the same thing. But the nice thing to remember is we've got charitable planning options. And if we have clients that need to be doing charitable planning, start having the conversations now. That way, when it comes time to pull the trigger, they're ready to do it, and we have good planning opportunities for our clients. So I appreciate everybody getting on. If you have questions, feel free to reach out, and if not, we'll talk again next week. Thank you.